Hey everyone, welcome back. Today was a really interesting tape because the headline indices looked constructive, but underneath the surface, it was not a clean everything up rally. SPY, QQQ, IWM, and DIA all finished green after the cooler CPI report, and IBIT, Bitcoin, Ethereum, crypto in general, absolutely rallied as the softer inflation print helped risk assets and lowered some of the immediate rate hike pressure. That was basically the scenario we mapped out yesterday. If CPI came in soft, yield should cool, growth should catch a bid, Bitcoin could get a liquidity risk appetite tailwind, and the market should try to stabilize inside the range. But the reason the day did not feel euphoric is that TLT barely moved. Oil stayed firm, software got hit hard by the IBM collapse, and geopolitics are still very much in the background. So the market did bounce, but it did not give us a full green light risk on confirmation. It gave us a controlled rebound inside the same range. Feel free to jump ahead using the YouTube chapter markers. And quick disclaimer, this is not financial advice. This is for educational purposes only. This is how I'm reading the market, managing my own portfolio, and thinking through trade architecture. Please hit subscribe to follow for more. And thank you so much to everybody who's already subscribed. The biggest stock story today was IBM. It had a historic collapse, falling roughly 25%. I even saw a Bloomberg report today that it was the stock's worst day since 1968. I can't believe it. I haven't checked it, but I mean, look at this move. That mattered way beyond IBM because it hit the software and enterprise tech complex broadly. If IBM is missing because of deal execution, client spending shifts, and weaker software momentum, the market immediately starts asking whether this is a company-specific problem or another warning shot for legacy enterprise software. The second story was Fed Chair Kevin Warsh, who pushed back against the idea that one cooler CPI print means mission accomplished, saying he would not cherry pick the data and that inflation remains above the target. That kept the rate story from getting too dovish, which helps explain why TLT did not explode higher, even though equities and Bitcoin responded positively to CPI. Story is Lucid, which had an absolutely terrible day. It tanked after bankruptcy and take-private rumors. However, Lucid denied that subsequently, had a spectacular recovery attempt, but was still down 16% on the day. The interesting read-through, though, is that if Lucid is a weaker competitor, that could potentially be tradable for Rivian. And I actually saw a breakthrough today on the 15 trend line. That's not enough for me on a small moment, but I am invested in this personally, so it was actually quite a nice signal. Finished up the news. Here's a basket of market moving headlines that caught my eye. Yum sold off on the Taco Bell Cyclospora diarrhea outbreak. Bank earnings were good, but mixed stock reactions essentially. So JPM was up, I believe Goldman Sachs was up, whereas Citi was down and Wells Fargo was also down. And then as far as geopolitical goes, we can look at USO or XLE to talk about oil. So geopolitics kept oil firm as U.S. Iran tensions continued around the Strait of Hormuz. The CPI report was the main macro event, and it came in softer than expected. Headline CPI fell month over month, core CPI was flat, and the year-over-year numbers cooled. That's exactly why equities were able to bounce and why Bitcoin caught such a strong bid. Lower inflation reduces pressure on the Fed, improves liquidity expectation, and generally helps risk assets. But there is one important caveat. A lot of the improvement came from the lower energy prices in June, while oil is already moving higher again because of the renewed U.S. Iran conflict. So the market liked the print, stocks bounced, yields eased, and TLT did not tank. But TLT also didn't surge, which tells me the bond market is not ready to declare the inflation problem solved. Tomorrow, the focus shifts to PPI, the Empire State Manufacturing Survey, and more Warsh testimony. Oh, and also the Fed Beige Book. It's not highlighted here, but it is important. If PPI confirms the cooler CPI trend and yields stay contained, the bulls have a chance to keep stabilizing the tape and push SPY toward the upper end of the 745 to 760 range and QQQ toward the upper end of the 700 to 733 range. We had talked about that range before. It's the expected move for the week for those indices that we had calculated at the close on Friday. On the other hand, if PPI is hot, especially with oil already moving higher, then today's CPI relief could quickly fade because the market will start to worry that June's inflation improvement was backwards looking and energy driven. So tomorrow is about confirmation. Do we get a second inflation data point that supports the rebound, or does producer inflation and oil risk start to push the market back toward the lower end of the range? All right, now let's look at the weather forecast using SPY as a proxy. I'm going to keep this one very quick because not a lot has happened. Second of all, we're getting more economic data tomorrow. So reading into this stuff doesn't make a whole lot of sense, except that you could see two things. The first thing to say is that we are still within the expected range for the week. So until we start to test one of those bounds, I'm not going to be too interested in forecasting based on this, because this is essentially a wait and see pattern. In fact, we've been waiting and seeing for about a month now, since 6/1. or 6.2 was really the peak there. We pulled back, and now we've been chopping around. We've been consolidating in this range, and it's anybody's guess as to what could happen here. However, my outlook for the year, just to interject that real quick here, is that we are going to have a pullback to the previous breakout. So we're going to have this breakout retest. And sometimes when these happen, they don't come all the way back down. That would be far too easy to trade. And other times they overshoot it because, again, it would be far too easy to trade if you just put your entries right there. But when it starts to come down there, that's when I start doing the whale watching that I've shown you guys on this channel. That's when I start looking at flows. That's when I start mapping out multiple confluences like RSI divergence, and also looking at pivot points. But for now, what I'll say is that we are chopping around here, and I'm waiting for more economic data and to do some cross-asset analysis. Like I said, looking at TLT, looking at energy, looking at all of the different indices, and seeing if there's any confluences there that are tradable for me and work out for my pathing. And also, like I said, I do assume we're going to come back down, but the other assumption based on earnings, I've seen a lot of analysts kind of model out what the upside target is, and most people are saying 800. For me, I did fib extensions from this low here, and I think actually from this high. Okay, so we went from the low here to the high here, then back to this low, and we can calculate the fib extensions from that pullback. And that's what this is. If you go back to Sunday's video, you can see how I do that. But essentially, the closest level I have to that is right here at 797. So that's probably where I would be targeting for any types of profits, but I would be taking profits along the way. Again, not financial advice, just how I'd be trading the market. So that's all I wanted to cover for the market forecast today. Of course, if you go back to Sunday's video, you can see more of it. Almost all of it's exactly still true because not a whole lot has happened over the course of the week. So just like the market has been largely range bound, individual names that we've been following have been largely range bound in the last few days. So I'm going to do something a little bit different for them today. I'm going to go through the Gex on each of them, as well as some of the pertinent levels based on that and on their charts, as opposed to doing what we normally do here. We're going to specifically just focus on that. So let's jump into the first one here. All right, so the first thing to look at is Microsoft. And so Microsoft had an interesting day because it was down 1.55%, and everybody thought this was a sympathy decline in sympathy with IBM, essentially. However, it only fell 1.55%, and for a company that was going through negative SaaS sentiment and a CapEx negative sentiment situation, for it to fall this little wasn't really that convincing to me for more continued downside for a number of reasons. The first reasons was right here, this was a neckline that we were watching on this smaller 1 hour time frame. And so we came down and we bounced off of it. So that's great. We could continue to decline after it, but the fact that we didn't today was really telling for me. But that was just the first part. The second part is my pivot points. I monitor these religiously. And so when we fell down into S2 right here, so this is a second level of support, and we're able to immediately bounce right off of it and then hold that. In fact, if you go down to a smaller time frame, it's like kind of that hot stovetop reaction, comes down, touches oof, and then it bounces right back up. It didn't do a full gap fill. I would have liked to see a gap fill that continues to the upside, but that's okay. We're going to be watching it for tomorrow to see how it does. And I can see right here, it's very small on your screen, I'm sure, that we are up just a little bit more in the after hour, but I still have that off so I can look at for tomorrow what my pivot points are. So that was the first part, but the second part about it isn't just the levels in isolation, it's the Gex. And so right here, I was watching this, and this right here is until the end of the month. This is the first month contract. This is the first expiration contract, and Microsoft has a option that expires tomorrow, actually. And that's a positive. It's in positive Gex right now. It's well above where the actual gamma flip line is calculated down here, but you can see that there's a really strong negative Gex cluster here, which maybe some algorithms probably would see that as the flip line. It's always something to watch, but we're well above that as well. There's a little bit of a liquidity pocket here, which just means that I think people are positioning for later expirations, which takes me up to the monthly expiration. And you can see what's happening here. And I've been watching this build out. At 400, we're just getting more and more positive Gex going. And we're going to be coming into a dealer cluster right up here. This is a positive Gex cluster. And what happens is you start to get pressure, selling pressure as it comes into that. The market makers are selling off their shares there to hedge their book. So as we break through 392, I'm going to expect some kind of acceleration towards 400. And this is why I actually picked up another call today. I was trading this. My algorithms were doing the scalping, so we made $28 on that. But when I'm starting to see positivity on some of those algorithms, I made discretionary trade if I get alerts. And so one of the alerts was the S2 mixed with positive Gex. That's something that I watch, not financial advice, but you should be watching the Gex to some degree if you're going to be doing these shorter term plays. Of course, if you have a longer term thesis, none of this really matters. What you're seeing is this consolidation zone around here. You had a lower low that was a liquidity sweep of this area with RSI bullish divergence. So for me, the bull case is still intact. In fact, I'd want to see this line start to mellow out and then curve back up before I expect price to break above it and hold strongly. So this is going to take a little bit longer to play out. And plus we have earnings coming up, which is going to be the larger catalyst. So that's just how I'm looking at Microsoft at the moment. Now let's jump into the next one. All right, so now let's look at Meta. And I almost picked up a few more shares today, but I want to show you how I'm actually playing this one because there's a similar compelling thing going on here, which has a lot to do with the front month expiration right here. So you can see we're in positive Gex, but this expires, I believe, tomorrow as well. Let me see. On the analysis. Yeah, so this is also one of the ones that has the weekly mid-week expirations. So that's what you're seeing there. And that's why my Gex after hours is a little funky. But I'm looking actually, because that's going to roll off, I'm looking to see what are we going to be at thereafter. And that's what I'm positioning for, especially in these mid-week expirations. These often represent some buying opportunities for me. And one of the reasons I was saying I wanted to pick up more shares is because the 700 strike is just absolutely massive now on the front month Gex. So I really like that as an upper target, 710. And it's not a crazy level if you look at the fibs that we have here. In fact, from this swing high that we had in February all the way down to this swing low that we had at the that March low, 710 wouldn't even be a full retracement of it. So it's not quite that crazy for me. And then from an extension standpoint, we don't have that much more to go. The other crazy part about that is for tomorrow, and also for today, if you're looking at the pivot points, today had a pivot point and tomorrow has one at 693. Today had a pivot point that was well above that at 707. So it's not an unexpected thing to be happening based on recent price action. And if you actually see what's going on here, basically, we're seeing profit taking at the best price possible. So every time it pops up, we have some selling. They wait till it pops up again. They do some selling. I bet you if I even look at this on a lower time frame, we might see some VWAP selling. Yeah, okay, it's above VWAP, push it down. Above VWAP, push it down. Comes back to the VWAP, push it down. And so you can actually see that happening on the larger time frame if you've been trading long enough. Just these like green candles or green days that are getting pushed down. And what's also happening is two things, and this is why I didn't pick up shares, is this trend line that broke, and it also corresponds with the 200 simple moving average there. So the reason I didn't pick up shares is I'm waiting for my alerts to be hit. I have an alert right here at 641, which is a reasonable spot based on tomorrow's pivot point S2. So I like that. But if we overshoot and come all the way down to pivot point S3, which would be at 625, that would be a wonderful entry for me. I think we may have to wait a day or two for that to happen. But if we do come back down to that levels, I'm selling some cash secured puts below the market, and I'm also going to pick up some more calls. My other account still has quite a bit of shares. I had 140 or I had 150 at some point, down to 140 that I sold at the peak of this. So I'll be looking to pick up a few more long-term shares, and that again, not financial advice, just how I'm playing Meta. But I just want to show you how looking at the Gex can inform us of what might be going on. And also, if you're not quite as cavalier, or if I'm not quite as cavalier, sometimes I'll start to buy spreads there where I'm targeting that exact strike, but I can have a larger time frame for it to play out because, well, for two reasons. One, volatility will not matter as much. That's the great thing about selling or buying a spread or selling a spread, is that you're not worried about a change in volatility because your short strike and your long strike are canceling each other out in terms of volatility, but you can capture the move with some leverage and more capital efficiency. Now let's jump into service. Now I'm going to keep this one quick because it's highly correlated with a lot of the other software stocks. The first thing to notice is that we are range bound between the fibs at the low that we had in April or end of March I believe their low is in April, and this swing high that we had on 6-1. So for the fibs, we're oscillating between the 618 and the 50% retracement of that drawdown there. So to me, this is actually still constructive. And the other thing about that fib there is I saw this as a Wyckoff accumulation pattern where we came down into it, had that impulse back up, came into the range, spring down below, recaptured, fake break it down, came into the range, are consolidating, are now hopefully having that show of strength for real. And we're going to have their earnings in not too long. So I think that's what a lot of this consolidation in this range the last few days is really about. So that's kind of the overview of how I'm seeing this pattern. And the upper target for me really is the 130. So we're going to go ahead and look and see. But also this 125 looks really good now that I mention it. So now let's go ahead and look at the Gex and see if we can, make a case for any of those levels, protect our downside, that kind of thing, and see how we can express a trade. So the first thing to note is that there's not a mid-week expiration on now. So we're going to look at the monthly contract right here. And it looks like 100 has this huge call wall there. So I think a lot of market participants are probably going to protect that, or market makers rather are going to protect that, and market participants are speculating above that level. I also have some cash secured puts at the 100 level. In fact, I think I have a few of them. They're slightly underwater at the moment in this account. Yeah, I have two now ones. They are at the $100 put. And again, they're very far out. That's how I play my cash secured puts. I have one for 66 DTE and one for 129 as I was scaling into those over time. But the way it's playing out on the chart, the 100 level looks like a lot of market participants have belief in that. And so that's right here. And that helps me also with my Wyckoff accumulation analysis right here, because that would say that really has formed a base, at least a base that's becoming institutionalized. So I like that. And then back on the Gex here for the upside, I'm also watching the cumulative Gex for the all expirations essentially, and that goes to 2028. But a lot of times people are using this to express just the long term, and they like the leverage they're getting, the lack of theta decay that they're getting. And so I'm monitoring this, and the 120 strike has been building, and the 150 strike has been building a lot too. So if we can get above that 120 strike, I don't see anything holding us back from 150. However, that 130 line right there is probably going to be near-term resistance, but we have these earnings right here. I will point out though, last time their earnings were phenomenal, the market still didn't like it. So it doesn't necessarily mean anything. However, all of this RSI bullish divergence that has been going on, and then some of the more recent price action and that call wall lead me to believe that earnings could be received a little bit better this time. But again, earnings are a binary event, so I'm not playing that necessarily, but it is a data point that's going to feed into my larger model, as this is a longer term play for me. The next one is CRM. And so Salesforce has some interesting Gex going on here, but let's look at the chart first, because CRM did something kind of interesting today. It outperformed a lot of the other software names, at least in the beginning of the day. And it's only down negative 2.4%, which doesn't sound like outperformance, except when you look at ServiceNow was down 5.76. And of course, Microsoft, like I said, had relative outperformance at 1.55, but it's not quite in the same volatility regime that CRM is in. It's not been swinging quite as much, but I saw more constructive price action, because if we come down to the 4-hour here, as I was watching this, I was starting to see this entire range be engulfed by this one candle. And if it was to hold, it would be particularly bullish. That didn't quite hold, but it got me very interested in looking at the Gex for it. And I'm still long-term bullish on CRM. It depends on which account I'm looking at. Like I said, I have a lot of different accounts here, and it doesn't really matter. You guys shouldn't really care about my accounts. My book is my book. You need to trade your own book, because they are weighted totally different, and I have multi-portfolio optimization going on, so it doesn't really matter. But the CRM plays that I do have are targeted for a much longer term. I'm holding the 94 and 66, as you saw with Service. Now I'm holding that in CRM. Plus, I have a bunch of CRMG, which is the leveraged fund, and those are holding up nicely here. I have to rebalance those from time to time, as you can tell, but they were down $20 on the day. But what I like about CRM from a level standpoint is that we came up into that 170 and got held down, and that 170 was this upper Gex Gex cluster. So what I really liked about it today was that it was respecting the Gex very well. That doesn't always happen. It happens a lot less when there's not a lot of Gex going on. And as you can see, this is one of the lower Gex names, meaning there's been less positioning. But if you looked at this just 2 days ago, there was very, very little Gex, meaning that not a lot of institutions were positioning necessarily, except if you go back yesterday and watch how some of the whales were positioning. It was very interesting to me. But anyway, on the long term, I'm seeing these strikes up here. I'm seeing this is still the 170 strike, so not a lot has changed going out the rest of the month. But thereafter, once that month rolls off, we're starting to see some positioning coming in at the 200. And I'm seeing this put wall at 165, which tends to be even better support to some degree than the call wall that we were seeing on service now. But again, these have a long time to go, and I imagine it's hedge shares for a lot of institutions that are holding them. But we talked about yesterday, it's very hard to read into that kind of thing. I just wanted to mention here, since I'm doing a lot more focus today on Gex. And then tomorrow, pricing wise, it wouldn't be weird to stay within this range. S1 is down here at that low end of these. It's essentially a fib bridge, and it has been respecting it quite well between the 23.6 and the 382 retracement on that. So I do like that, and we're also now above the 50 simple moving average on the 4 hour, and then on the daily we've gotten above the 20 simple moving average, but we're being held down by the 50. So I need to see across there before I feel a bit better on that. Although you could tell this is in a different phase than service now was. We haven't fully recovered back into this accumulation range, which I would want to see to consider this spring, but it looks like it could be happening. That being said, there's a lot more room for this to run. So I'm still liking that. The other thing to point out, I didn't put this out in some of the other ones. If you guys actually just like candle patterns more than I do, because as you see, I trade levels and flow more than I trade anything, as well as fundamentals, because I'm a quantitative trader. And for candlestick patterns, that's not really something at the institutional level that is done as much, but it might be something my scalping bots are doing, but even then it's actually a lot more tick based and flows. So anyway, I digress. What I wanted to say is, if you are trading candlesticks, this is not a lot of structure. And so it's very easy to just essentially, I wouldn't necessarily call it a short squeeze, but blast right up through all of that. There's a void there. There's an air pocket, essentially. Not a lot of structure to break through. All right, so the next one is Oracle, and Oracle doesn't look like the rest of them. I mean, we're deeply in negative Gex, and there is going to be a lot to fight to get up through all of this negativity. However, when it rolls off, it could be very interesting because, as you see here, this is near-term Gex. This rolls off on Friday, and this is the rest of the month, and it's cumulative, meaning when I'm calculating it, I'm calculating the rest of the expirations for the month, and I'm adding them all together, and that includes this expiration. When this rolls off, this has more negative Gex than this does, which means without it, the rest of the month will be positive. So that's something I'm watching. And it also means that this cumulative Gex will be more positive, but you have to wait to see how it unfolds, especially on the longer terms. But I do like those kind of divergences there when I can see that the cumulative Gex for the rest of the month is positive, but the near term is negative, which means that we could have more downside. We could have more downside this month. And in fact, if we look at Oracle there, we were talking about maybe yesterday was capitulation, but it absolutely wasn't. It broke through this support right here and it's continued down. So I would expect that we might come down to this 120. And if we were watching whales yesterday, that's about where we saw it. I'm starting to scale in around here. That's me. It's not financial advice. But the other thing I wanted to mention, just getting back into what we were talking about institutions yesterday, let's talk about some more whale tape reading, because today's activity largely reinforces that same kind of thing. Big money appears to be positioning for stabilization, but not necessarily an immediate V-shaped recovery, which, as you just saw in the Gex, is meaningful. So this morning, someone sold 5,000 August $115 puts and 5,150 calls in what looks like an almost perfectly delta neutral volatility trade, essentially betting that Oracle stays contained inside a broad range while the expensive option premiums decay. So that's not outright bullish, but it does suggest that the trader is not expecting an uncontrolled collapse. And if they already own shares, the calls would be covered while the puts represent a willingness to accumulate more at lower price. So later then, however, to make this even more complicated to try to figure out the 3D chess, someone bought 2,500 deep in the money $190 puts expiring this week, creating roughly 219 shares of negative delta. And that could be a bearish stock equivalent position, but it could also just as easily be protection against a large long position, a closing trade, or one leg of a larger structure we can't see. So the updated whale tape read read is still base building with caution. That's how I would read it. Sophisticated traders are continuing to sell the panic and bet on a broad range, but there's clearly still demand for protection around the current price. And for my bullish recovery thesis, which I actually have based on fundamentals for Oracle here, not everybody's focused on just one fundamental there, which is essentially their debt. And I think that's valid for sure, but I'm not entirely sure. I'm taking a contrarian position here. I'm not entirely sure about it based on their EPS and revenue, and then also the nature of this sell-off. So I'm, again, going to have some very conservative targets with my upside here. My conservative targets probably be around 160 when we get back into this trading range and then reassess that. But essentially, Oracle needs to hold this 130 area, so it needs to get back above it and then reclaim that 140 area, so that this will have been the shakeout, the liquidity sweep, and we'll see how the week plays out. And then if we get back above that 140 and close above that 143, 145 gamma flip zone, I will be looking for some upper targets at that point. All right, so next let's look at PayPal. This is one I've covered a number of times. I did hold a number of long calls, but I closed out some of them yesterday because I trade a lot of my long call plays. I have multiple calls, I have multiple targets, but if we have a pop on a specific day, I might start trimming. And that's just good practice with calls, in my opinion. Essentially, you want to capture that expansion in Delta before it pulls back. And that's another reason I make sure that I'm buying things that I can scale in and out of with calls, essentially. And let me know if you guys want to see in a video how I approach options trading and option sizing, because I think that's really quite important. But anyway, what I like to see today on PayPal made me continue to hold one. I even thought about adding again, but then I took a double take, and I'll tell you why. So the 50 strike is building, and it's been building. And here, we can see a few things. One is that this is just the end of the week, so it's very likely to get there by the end of the week. Likely, and maybe we cap out before that, but then this is for the rest of the month, and so it's likely that that's going to be the rest of the move for a little while. And then you can also see it for cumulative Gex for all expirations, which goes through 2028, as I said, and that is still the biggest strike. So I'm probably going to look to close my calls at that point, maybe then start to transition to some cash secured puts with a few shares kind of thing to ride it out if I like the fundamentals. But one of the things that I like about PayPal is, people talking about their stable coins, and that brings me to the next play. All right, the last one to talk about is CRCL. So I'm not going to spend a lot of time on this, but it's one of those extra fun ones that I'm just throwing in here. As you guys can see, I always have a large portfolio of different things, and I only cover a few on the channel. But this one had a reason to talk about it today. We were seeing headlines about the United States and the UK and stablecoin legislation. Whenever I see legislation headlines like that, what I do like to do, because I'm not a legislation expert, of course, but there are people out there who are giving the large institutions information that you and I don't have. And that's the kind of thing I am an expert at, is looking for their footprint, their fingerprint, what have you, the signs of those whales in the market. So immediately when that happens, I start to look at the bottoms and see what kind of divergences I can see. And of course, we saw bullish RSI divergence on the daily here on CRCL from February. And there's been a lot going on with stablecoins in general. And it's not a theme I'm following super close, but with what happened with PayPal today and then seeing those headlines, I went immediately to CRCL. And you can look up them if you want. I don't want to get into the fundamentals. I feel like that bored people in some of my previous videos, but let me know if you actually want to see that before I cover any stock, but these videos get quite long if I do that. But anyway, the first thing I notice is this bullish RSI divergence, and that immediately says something to me that there's starting to be some accumulation, and we actually saw a huge pop from that. This was quite a run from that RSI divergence. That's exactly what you want to see, going from 49 all the way up to 140. That is, if I would have caught that play, I would have felt relatively good about it. And it was a simple RSI bullish divergence right here. And it caught it to the T if you would have played that. Okay, but I didn't. And that's fine because I didn't have a thesis on that point. But now I'm seeing not only do we have that RSI bullish divergence, but we're starting to have headlines. And when I zoom into some of the smaller time frames, I'm starting to see it again. So if we come down to the 1 hour here, you have a series of bullish RSI divergence. Price is higher, now it gets lower. We have a basically equal RSI. Price gets lower, equal to slightly higher. Price gets lower, higher RSI. I believe price gets lower again, slightly higher. And then if you even just go from here back to that, you have bullish RSI divergence. So there's been a number of them starting to happen. And I like to see it serially. The other thing I like to see is you feel free to skip ahead if this bores you to death, but these regression channels, there's a pattern that's well known on these, on the hourly, maybe not well known, but it's been back tested. I've been trading it for a few years. Essentially, if you have a low wick that touches the second deviation from the mean, that's what these lines are. These are standard deviations away from the mean price that's charted over the length of the chart, that rejects and then continues over, hits the other side of this, essentially shows 2 standard deviations away from the mean on the other side, sweeps that liquidity and returns to that price, it's a really good entrance. I know that's a really long pattern to play out, and that's why we algorithmically trade that. But when I saw that happening as well, even though I didn't trade that because I didn't have an algo running on this name, you don't just have an algo running and it goes over the entire universe of all stocks. You're starting to filter for them and then run the algos on them. But when I zoomed in and saw that pattern starting to form, I said, maybe we're getting close to a tradable base here because you don't see that pattern quite as much. That mixed with the RSI divergences I was starting to see were compelling. However, I do want to point out on the Gex what's going on. So I'm seeing some positive Gex building up here at 70 roughly, and a really nice outlier over here at 75. So that's interesting to me. And then for the rest of the month, I'm also seeing at 70, even though we're on negative Gex over here. Oh, sorry, we're not. We're below the flip line, but we're still in positive Gex. So interesting read. That does complicate it. We're going to have some choppy price action probably. So the way that I express this trade, because I think that's also important for people, two ways. I found a 157 out of the money call option that I liked. And again, I'm targeting the 70. So I'm going to be cutting this when we get to 70 no matter what, unless we gap way above it, and then I'll probably put on a spread, but more than likely I'll probably be closing it at that point. And then the other way to limit my risk, generally depending on how you look at limiting your risk, of course, is I sold a cash secure put well below the market at the 66 DTA at the 45 strike for $2.50 when I sold it, I believe. So my cost basis is $42.50 if I should get assigned. And again, if we look at the Gex, let's see what would $42.50 look like. Essentially well below where any market participants are hedging at the moment. Although this can change quickly because this is not a lot of Gex, which sometimes mean that market makers or large institutions have kind of stepped out of the way for the moment. And that could be because of legislation. So it's a very interesting trade for me. And I just wanted to bring it to everybody's attention, not financial advice, just how I'm watching the market. Thanks so much for watching. And if you found this video helpful, please subscribe. It really means the world to me. It helps me make these videos for you, and turn on notifications to get updates, and leave a comment with the tickers you want me to cover next. I respond to every single comment. And if you like planning out trades like a quant, check out alphaharmonic.io. And thanks so much for watching. Happy investing and stay safe out there.